Imagine starting to invest in the late 1990s. The internet was changing everything. Prices were rising fast. Confidence was everywhere. And people believed the old rules no longer applied. Then the cycle turned. The NASDAQ fell nearly 80%. The technology survived, but a large amount of wealth did not. When I look at the market today, I see a similar machine forming, driven by artificial intelligence instead of the internet. Expectations are expanding faster than cash flows, and capital is concentrating into a small number of powerful engines. The real question is not whether AI will change the world. The question is how much of your money is now connected to a single growth engine, and what happens to your portfolio if that engine begins to slow down. When I look at the stock market today, I do not see a broadly balanced system. I see a machine that is being driven by a very small number of powerful components. These components are often referred to as the Magnificent Seven: Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and Nvidia. Together, these companies now represent more than a third of the entire S&P 500 index. That detail matters because it changes how risk works inside the system. Many investors believe they are diversified because they own index funds. But diversification only works when returns are driven by many independent sources. When performance becomes concentrated, diversification becomes an illusion. This means that even if you own a single share of a broad market index, a large portion of your future returns depends on the same narrow set of outcomes. These 7 companies are not just large, they are deeply interconnected through a single theme: artificial intelligence. Each one is racing to build, deploy, and control AI system, and each one is making strategic decisions that affect the others. In a machine like this, the failure or slowdown of one major component does not stay isolated. It transmits stress through the entire structure. The reason this concentration has grown is not accidental. Capital naturally flows toward perceived winners, especially during the early stages of a powerful technological cycle. As AI gained attention, money followed performance, and performance reinforced belief. Prices rose, indexes became heavier, and passive investment flows automatically increased exposure to the same names. Over time, this created a feedback loop where success attracted more capital, and more capital increased success, at least on the surface. From a system perspective, this changes the nature of market risk. The market no longer rises or falls primarily because of thousands of independent business decisions. It moves because a small group of companies share similar assumptions about growth, investment, and technological progress. If those assumptions hold, returns can remain strong for longer than many expect. But if those assumptions weaken, the adjustment will not be gradual. It will be fast. Because the same concentration that amplifies gains also amplifies losses. This is why it is important to separate belief from structure. Belief says AI will transform the economy. Structure asks how many assets are priced, as if that outcome is already guaranteed. Belief is emotional and forward-looking. Structure is mechanical and unforgiving. When structure becomes unbalanced, outcomes become binary rather than smooth. The key takeaway is not that these companies are bad businesses. Many of them are extraordinary. The issue is that the market has organized itself around a single narrative, and narratives are fragile. When too much capital depends on one story continuing without interruption, the system becomes sensitive to even small changes in expectations. That sensitivity is where risk quietly builds, often while confidence feels strongest. To understand why the market feels stable on the surface, you need to look at where growth is actually coming from. Right now, the most important driver in the entire system is artificial intelligence spending. A small group of dominant companies is committing an unprecedented amount of capital to build AI infrastructure. And this spending is acting as a powerful lever that supports both economic activity and asset prices. Tesla is allocating billions toward autonomous driving systems and AI development. Apple is investing heavily to redesign its core products around more advanced intelligence. Meta is spending tens of billions on data centers and virtual platforms. Google is restructuring its search and advertising businesses around AI-driven models. Microsoft is committing massive resources to OpenAI and large-scale computing. Amazon is investing more than any other player to expand cloud infrastructure through AWS. When combined, these investments reach hundreds of billions of dollars in a single year. This level of spending is historically unusual. It rivals the economic output of entire countries, which tells you how concentrated growth has become. Instead of being distributed across many sectors and millions of decision makers, a meaningful portion of economic momentum is now coming from a handful of corporate balance sheets. This concentration creates efficiency in the short term, but fragility in the long term. As long as these companies keep spending, the machine continues to run smoothly. Jobs are created, suppliers are paid, and confidence remains high. Asset prices reflect this stability. Even when underlying economic conditions are mixed, the problem is not that this spending exists. The problem is what happens if it slows. When a system becomes dependent on one dominant source of fuel, it loses redundancy. If even a few of these companies decide to delay investments, reduce capital expenditures, or reassess timelines, the impact will not be limited to their stock prices. It will ripple outward through chip manufacturers, energy providers, construction firms, software vendors, and ultimately into index funds and retirement portfolios. The system reacts as a whole, not as isolated parts. The reason these companies are willing to spend so aggressively is because AI represents more than incremental improvement. It represents potential long-term control over productivity, data, and economic power. Whoever builds the most capable systems first gains structural advantages that are difficult to reverse. This is why the race is not only corporate but geopolitical. Nations view AI leadership as a strategic necessity, which further reinforces the belief that spending must continue regardless of short-term profitability. From an investment perspective, this creates a critical dependency. Market stability is no longer anchored primarily to current earnings. It is anchored to the assumption that spending will persist and that future returns will justify present costs. As long as confidence in that assumption remains high, prices can stay elevated. But confidence is not permanent. Spending can continue for years, but it cannot grow faster than returns forever. When the cost of building the future rises faster than the value it produces, the system begins to strain. At that point, the market does not need a crisis to reprice. It only needs spending to slow, to see where hidden risk begins to form. You need to look closely at how money is moving inside the AI system. On the surface, everything appears logical. Chip designers like NVIDIA create the hardware that powers AI models. AI companies such as OpenAI purchase those chips to train their systems. Data center operators like Oracle and other infrastructure providers buy massive amounts of hardware and lease computing power back to AI firms. At first glance, this looks like a normal supply chain. Each participant appears to be creating value and recording revenue. But when you slow the system down and trace the flows of capital, the structure becomes more circular than it seems. The process often starts with large technology companies providing funding to AI developers. That capital is then used to pay for cloud services and computing infrastructure, often supplied by the same companies that provided the funding in the first place. The cloud providers then use that revenue to purchase large volumes of chips from manufacturers like NVIDIA. NVIDIA, in turn, reinvests capital back into the AI companies that are buying its products. Each transaction is real, and each company can legitimately record revenue. However, the economic substance of the system depends on whether new value is being created or whether money is largely circulating within a closed loop. This is where the machine begins to resemble a feedback system rather than a linear engine. When capital flows in a circle, reported growth can accelerate faster than underlying profitability. Revenue increases, valuations expand, and confidence builds, even though the system has not yet proven its ability to generate sustainable cash flows from end customers. In simple terms, the system can look very productive while still relying heavily on internal recycling of capital. This dynamic matters because markets price companies based on expectations of future earnings, not just current activity. When investors see rapid revenue growth across multiple firms in the same ecosystem, they often assume that demand is broad and durable. But if a meaningful portion of that revenue is indirectly funded by the same group of balance sheets, the system becomes vulnerable to changes in behavior. If funding slows, or if companies begin to question returns on investment, the loop weakens quickly. NVIDIA sits at the center of this structure. It sells the critical tools that everyone needs, and it sells them to every major player in the system. Its growth has been extraordinary, driven by demand from cloud providers, AI developers, and large technology platforms. At the same time, it reinvests capital back into the ecosystem, reinforcing demand for its own products. This position makes NVIDIA extremely powerful, but it also makes the entire system more interdependent. The risk does not come from deception. It comes from reflexivity. When companies invest based on expectations created by their own spending, the system becomes sensitive to shifts in confidence. As long as everyone believes the future payoff will justify today's costs, the machine continues to accelerate. But when belief weakens, circular systems unwind faster than linear ones. The danger is not that the machine stops suddenly, but that it loses momentum before markets are prepared for it. At the center of this entire machine sits a simple but uncomfortable problem. Artificial intelligence has captured enormous attention, but it has not yet proven that it can generate profits at a scale that justifies current valuations. Many of the most influential AI companies are valued as if future cash flows are already guaranteed, even though today they are still losing money. This gap between expectation and reality is where risk quietly accumulates. Markets can tolerate losses for a long time, but they cannot tolerate uncertainty about whether those losses will ever turn into sustainable profits. The justification for these valuations rests on potential rather than performance. AI platforms attract hundreds of millions of users every week, and that level of engagement is extremely valuable. It produces data, attention, and behavioral insight at a scale that few technologies in history have achieved. In theory, this creates several powerful levers for monetization. Companies can introduce advertising directly into AI interactions. They can allow businesses to promote products and services inside conversations. They can sell premium access to individuals and enterprise clients who become dependent on these tools. They can also position AI as a replacement for human labor, offering corporations lower costs and higher efficiency over time. All of these paths could lead to substantial profits, but none of them are fully proven yet. Until they are, valuations depend on belief that progress will continue at a rapid pace and that users will eventually accept higher prices or more aggressive monetization. This belief is widespread, but belief alone does not produce cash flow. It only supports prices as long as confidence remains intact. There is also a strategic dimension to this behavior. AI companies are betting that once businesses integrate these systems deeply into their operations, switching costs will become extremely high. At that point, customers may have little choice but to keep paying, even if prices rise significantly. This is a rational strategy, and it has worked before in other technology cycles. But it requires time, and it requires continued improvement in performance. If progress slows before dependency is fully established, pricing power weakens. From a system perspective, this creates a timing risk. Spending is happening now. Losses are happening now. Profits are expected later. As long as investors believe that later is close and inevitable, the machine continues to run. But if the timeline stretches, or if returns appear smaller than expected, the system must adjust. That adjustment usually shows up first in valuations, not in headlines. This is why the question is not whether AI is useful. It clearly is. The question is whether the economic value being created today is sufficient to support the prices being paid for future dominance. When markets price perfection, even small disappointments can have large effects. The danger is not that AI fails. The danger is that it succeeds more slowly than the system is currently assuming. For the market to justify current valuations, it is not enough for artificial intelligence to be useful. Progress must continue at a rapid pace. The entire system is built on the assumption that AI capabilities will keep improving quickly and that each new generation will unlock new commercial value. This assumption acts like a hidden pillar supporting prices across the ecosystem. If that pillar weakens, the system becomes unstable. One of the least discussed risks to this assumption is something known as the data wall. For years, AI systems have improved by consuming massive amounts of existing human-generated data. Books, articles, research papers, images, videos, and online conversations have all been used to train increasingly powerful models. This has created the impression of constant acceleration. However, this process relies on a finite resource. The amount of high-quality public data produced by humans is limited. Estimates suggest that within a few years, AI systems will have consumed most of the accessible human-generated content available online. When that happens, the nature of progress changes. Up to this point, improvement has been driven by scale. More data, more computing power, and larger models have produced better results. But once the supply of new training data slows, each additional unit of progress becomes harder to achieve. Gains may still occur, but they are likely to come more slowly and at a higher cost. From a system perspective, this matters because markets are pricing AI companies as if rapid improvement is guaranteed rather than conditional. When progress slows, expectations must adjust. That adjustment does not require failure. It only requires reality to move at a different speed than belief. Markets tend to extrapolate recent trends far into the future, especially during early stages of powerful cycles. But history shows that technological progress is rarely linear. It moves in bursts, followed by periods of consolidation where systems adapt and limitations become visible. There is debate about whether the data wall can be overcome. Humans learn not only from data, but from interaction with the physical world. Some believe AI systems will eventually do the same, learning through simulation, real-world feedback, or new forms of synthetic data. This may be true, but even if it is, it introduces uncertainty around timelines, costs, and effectiveness. Uncertainty is what markets struggle with most. From an investment standpoint, the issue is not whether AI can eventually break through this constraint. The issue is that current prices assume it will happen smoothly and soon. If progress becomes more incremental, the justification for paying today for far future dominance weakens. Valuations do not collapse because innovation stops. They reprice because confidence in speed and scale changes. This is how cycles often turn, not with a single dramatic failure, but with a gradual realization that growth is harder than expected. When that realization spreads, expectations compress, multiples shrink, and assets that were priced for perfection become vulnerable. The data wall represents a structural limit that the system has not yet fully priced in, and limits are where optimism often meets reality. When you step back and compare what is happening today with the dot-com cycle of the late 1990s, the similarities become easier to see. Back then, the internet was clearly going to change the world, and it did. But investors confused technological transformation with guaranteed investment returns. Capital rushed in faster than profits could materialize. Expectations expanded beyond reality. And when growth failed to meet those expectations, Prices adjusted violently. The key lesson was not that the technology failed, but that the timing and pricing of assets were wrong. The same question applies to artificial intelligence today. AI is fundamentally different from many dot-com era companies because it already has real utility. It is being used by individuals, corporations, and governments at scale. That matters. However, bubbles are not defined by useless technology. They're defined by systems where expectations grow faster than cash flows, where capital concentrates into a narrow theme, and where confidence replaces uncertainty. On those dimensions, the current cycle looks familiar. Valuations are high, capital spending is extreme, and a large share of the market depends on a single narrative continuing without interruption. The difficulty is that no one can know where we are in the cycle. This could be the early phase of a long expansion, or it could be closer to a peak than most investors realize. Markets rarely provide clear signals in real time. That uncertainty is why trying to predict exact turning points is usually a mistake. A better approach is to manage exposure based on probabilities rather than convictions. In systems like this, the goal is not to be right about timing, but to remain resilient across different outcomes. From that perspective, the most rational response is not panic and not blind optimism. It is discipline. Continuing to invest gradually allows participation if growth continues, while avoiding the risk of committing everything at inflated prices. Avoiding debt and leverage reduces vulnerability if prices fall. Diversification across different asset classes reduces dependence on a single economic engine. These are not strategies designed to maximize short-term returns. They are strategies designed to survive cycles. History shows that the biggest opportunities often appear during periods of stress. When prices fall, future returns tend to rise for those who can continue investing. This only works for investors who have prepared in advance, who are not forced sellers, and who understand that drawdowns are part of the evolutionary process of markets. Pain creates learning, and learning leads to better decisions over time. The most important mistake investors make during periods like this is believing that the current cycle is exempt from historical patterns. Every generation believes its technology is different enough to escape the rules of valuation and risk. It never is. Progress continues, but prices still fluctuate around reality. Understanding that difference allows you to stay calm when others are emotional and to act when others freeze. The outcome of the AI cycle will not be determined by headlines or hype. It will be determined by whether future cash flows justify today's prices. Until that answer becomes clear, the system remains vulnerable to shifts in belief. The question every investor must answer is not whether AI will succeed, but whether their portfolio is prepared for success to arrive more slowly than expected.